the next part is that also the timing of the demolition. That can have an influence with the lender with regards to the value of the property. So if, say for example, if not only demolition but the subdivision, if it was there was a house on the property and you were keeping the house and you subdivide, cut off half of the block and you've got a vacant block and you've got the house, the land now on that original home is smaller. That can drop the value of that property, which means then that the lender won't lend as much. So depending on the size of your loan, you may have, some cases you may have to put money in because the lender's saying the value of the property is reduced, you've sold the block, and so therefore they want you to put money in to reduce that loan down. Same thing can happen when a house is demolished. There may, even if it's I had one recently, even though they bought the property for land value, there was a house on it. The house, the valuer still added about $30,000-$50,000 for the dwelling. When that house is removed, you then only have the land value. So if you're doing a subdivision, whenever you go to change the title, the lender has to give permission for that subdivision to go through because they've got a mortgage on the property. When they do that, they'll generally send out a valuer to inspect the property. So if the valuer goes out and inspects it and now it's a vacant block of land and no home on it, it could influence the lender where they say, our security's changed, we want you to put more money in. So you've got to be careful of the timing of when you do it because that can influence if you're creating a new title, can the lender take security over that title? What's the time frame before they can do that? And so you could be in a situation where you've actually got to come up with more capital if you're not careful.
That's worth considering.
It's one of those things that a lot of people don't think of, but it can raise its head and cause problems. The other part is that from doing the subdivision, the increase in value, which is what most people will be doing this for, is the increase in value will not be recognised by the lenders until they're able to take security or register a mortgage on those new titles. Now, generally, the titles don't have to be physical titles don't have to be issued, but they need to be submitted and lodged with the Lands Titles Office. Now, what that means then is that you'd have to have all your council approval in place. You would need to have all your deposits that you have to pay to different government agencies or departments. That needs to be all paid. It has to be approved and accepted by the Lands Titles Office. And once that's happened, then the wording that I understand is they lodge it. Once it's lodged, the lender can register a mortgage on what they call a pickup, which they're picking up on the process from when it's been lodged to when the physical titles are issued. So at that point of time, a lender can register their mortgage. They will accept the value of that, the increased value, and you can access your equity or use that equity to help you go to the next stage. But until that happens, they won't recognise the value there.
So Steve, how soon can someone organise finance for construction?
Okay, if they're wanting to use the increase in equity or value from the subdivision, then if you plan it, you could probably start submitting the finance application for, say, a pre-approval, subject to the subdivision being accepted. Maybe 6 weeks before you expect the subdivision to be, the titles to be lodged, because you need to also pre-plan and have all your building packages ready as well. So you can get the valuer for the lender can't value the property with the construction and the subdivision unless they've got all the building package from the builder, which would include, contracts, plans, specifications, and all the details on the subdivision, the plans and all that on that. So you could get all that in place based on the value of the property once the titles are issued, and then so you'd have all the finance ready to go, but the lender can't settle in advance funds until they can register their mortgage on a pickup, which is when the title's been lodged. Okay, another thing to consider too, and this is again up front, think about this, is are you going to be using a builder and are you going to have that builder on a fixed price contract, or are you going to be an owner builder, or are you going to have cost plus? From a lending perspective, if you're trying to get the maximum borrowings and the most efficiency, you need to work with a fixed price contract with the builder. If you go into owner builders, there are some lenders that will accept them, but there's quite a lot of lenders that won't touch owner builders. They won't lend to them at all. So you need to be clear which way you're going to go up front, because again, that can influence whether you can do the deal or not, or which lenders and how much equity you have to put in.
And is that because the lenders are concerned with cost blowouts?
That's correct. They're probably their biggest concern is that we get halfway through the project and they run out of money, and so then the lender has a home that's half finished. And so they're very cautious and concerned, and unfortunately they've got records of people in the past that have actually done that. So they get very cautious and scared about it. And as I say, there's a number of lenders that will not even look or approve a loan if there's owner builder or there's not a fixed price contract.
Sure.
Another part that leads on from there is also with even having a fixed price contract, a lot of people will say, oh, but the builder's too expensive to do maybe the paving or carpets and curtains. So they'll go and get quotes for other contractors to do that work to finish it off so that it's ready for a tenant to move in. You have to be careful again with that, because some lenders, if you're providing too many quotes, they will say that you're an owner builder. Other lenders are okay with it, but again, if you're going to do that type of work yourself and coordinate it yourself and have subcontractors, tradespeople or businesses provide that additional work, you need to provide written quotes up front along with your builder's package so that the valuer can include that into your overall price. And that will also add value to your home, and it means you can borrow against that.
Good.
For the lender to organise the valuation of the property, you will need to have a number of things provided from your builder. So you'll need your building contract, plans, specifications, engineers and footings report, any variations, which is where you may go and do selections or you make changes after you've already entered into your building contract, which could increase or decrease the price. We need copies of those variations. We need quotes for any of the extra work that you're doing or organising yourself outside of the builder. And we need all of that before the valuation is done by the lender, so that we know that we've got the valuer is including everything you want. If that didn't happen and there was 20,000 of additional work that wasn't included in the valuation, then the lender won't give you the money for it. They won't lend you the money. The lender will always hold back the money that is required to complete and finish the construction of the home. And so if you don't include everything, it gets very complicated. In some cases, we've had to go and represent the whole building package again, get another valuation done, which is extra costs, and get their loan increased. And a lot of lenders don't like doing that.
So what are some of the things that can stop people from getting their finance, and what are their options?
Okay. There's a number of things that influence whether they can get their finance. One is their personal situation. Sometimes it's bad credit history can prevent them from getting their finance. Sometimes is that they don't have enough equity, they don't have enough means to be able to do the project. It can also be a lack of income, lack of knowledge can also come into it as well. It could be that they've had a lot of activity in the past. Lenders may be concerned. They may classify, if it's a seasoned investor that has got a lot of investment properties, and that some lenders may view it as it's now a commercial transaction. So the ways around it, or the ways that I've seen people get around it, is that one, you can start looking at more alternative lenders. There are some lenders that will look at people that have got some poor history on their credit. There's some that will look at properties in different locations. You'll generally find that it will cost you more in setup costs, and it will also cost you probably more in the amount of money deposit you have to put down. Another option is that a number of people have then sought a joint venture partner to help them. Maybe the partner, once they know where weakness is that's preventing them from getting the finance, they may be able to find a joint venture partner who's got those strengths. So if someone hasn't got the income, they might be able to find someone that will go in with them to back up the income. Or someone hasn't got enough equity, they may find someone that will join them and they'll provide the equity. Or someone who's got the good credit rating could then get the finance, and they can come up with other ways of being able to work together in a partnership.
And obviously the joint venture partner will receive a share of the profits.
That's generally what I see would happen, yes. Yeah, you know, as an investor, I wouldn't want to take on a liability or take on a joint venture project without sharing in the profits of it.
Exactly.
What I'll do is I'll just run through some of the, I suppose, criteria and some of the things to be aware of when you're looking at selecting a lender for the finance for a property you're going to develop. So the things to be aware of would be that, is it a full doc or low doc loan? Because that influences, one, the lender, your interest rates, also the amount of deposit that you have to put down to buy the property. Are you working with a fixed price builder's contract, or you're working as an owner builder, or occasionally you see some where they've got cost plus, where it's more like a project management through a builder. Also, are you doing some work or organising some work outside of the builder for like carpets, curtains, landscaping, and how many of those items you're going to do yourself? Are you getting quotes for them? Things like that. That influences which lender you go to. Another one would be how much deposit or equity have you got available to go towards the purchase and to complete this construction. Again, that can influence which lenders you can go to. The ownership structure can also influence the lenders. Some lenders won't work with unit trusts, or if it's a low doc, some won't lend to companies and trusts anymore. So those sort of things will influence which lender you go to. The number of dwellings that are going to be on one title, or the number of titles that you're going to be subdividing or creating. In some cases, the number of dwellings on one title, you might have one dwelling per title, but there may be some situations where you actually start building the homes before the titles have been created. That then can influence which lender you go to, because you will have more than one dwelling on one title, but it may speed up your process to what you're trying to achieve. Some councils will allow you to build the homes before the subdivision's been fully approved. So that's something just to keep in mind there. Are you selling or keeping the property? Again, that could influence your lender, because you may, if you're going to sell the property, you may be conscious about the fees to get out of it. Some lenders have fairly high exit fees if you pay the loan out within maybe the first 3 years, something like that. You need to be aware of that. From a personal point of view, from a mortgage broker's point of view, another thing to be aware of, or to be sympathetic with the mortgage broker, is that a lot of lenders now, if the loan is paid out early, within 12 to 18 months, they'll claw back all the commission. So a mortgage broker would probably like to know whether you are selling it or keeping it, because it will influence whether they're going to get paid for all the work they're doing. The location of the property, the size of the property, and the zoning of the property can also influence which lenders you go to. Some lenders will only look at metropolitan areas. Other lenders will look at properties on larger acreage. And zonings can also affect what they'll do. It affects probably more so, or it can affect, one, will they lend you the money, and two, how much they'll lend against the value of the property. So they're things to be aware of up front. We go into another depth now, which is how many existing investment properties do you already have? Some lenders and also some mortgage insurers are a bit concerned if you've already got a large number of investment properties, because they can start to say, oh, you're more of a developer, a commercial activity than a residential investor. So knowing that background can influence which lender you go to, or the lender or the mortgage insurer that's used. Your current financial position, taking into account your assets and also all your liabilities, credit cards, existing car loans, existing mortgages, those type of things need to be looked at, because that can influence which lender you go to. Also, your financial history and activity. So what you've done in the past can influence what you're doing now. So that could be that some people might have had a situation in the past that caused them to get a bad credit rating, or it could be that they've been active and they've inquired a lot for finance in the past. And the lenders can say, or the mortgage insurers can say, that look, you've had too much activity, we're not comfortable, we won't lend you the money. So knowing what your past history has been and how much active you've been in borrowing money can also influence which lender that you go to now. If you're going to sell the property, then another one to think of is those early repayment fees. You need to be aware of the lender. Some lenders charge fairly hefty early repayment fees and others don't. But then if you're keeping the property long term, that's not an issue. One of the things that I would add is also too, from a finance point of view, from a structuring and from an investor's point of view, I would always recommend that the best way is to structure the finance on the property you're purchasing and to develop as a standalone separate mortgage with separate security. Don't link them up to the other properties.
Or cross-collateralise.
And don't cross-collateralise them. It gives you much more flexibility to choose the lender you're going to use, because you're doing this to create value, increase the value of the property. So you want a lender that will let you do what you want to do. If you use the same lender or cross-collateralise, you then are limiting your choices. So if you're, say, using your home and you're with Bank X, if you're going to cross-collateralise and use the equity and take one loan out, you'll probably have to stay with Bank X. But Bank X may not do what you want to do. So you're better to structure yourself in a way that you can access the equity from the properties that you've already got and use that as a deposit to fund the purchase. And then you can have it completely separate. You can have different ownership, and you also have the ability to pick and choose which lender will do what you want to do.
Sounds like a good idea.
Yeah. Now, one of the things I'll just highlight here is that through that process of selecting lenders, I've not mentioned interest rates or the upfront fees and charges. And the reason that I haven't introduced them is because really, this type of finance is for you to create wealth. And so you're really focusing on the lender who will let you do what you want to do. And the last thing is then interest rates and fees and charges, because it's no good going to a lender that's got the cheapest interest rate if they're not going to lend you the money or let you do what you want to do. Exactly. Or you save $500 or $600 in an application fee, but they've got heavy exit penalties because you want to get out early, or they'll lend you $50,000 less than another lender. So you've got to look at the bigger picture and focus on what, as an investor, you're focusing on what am I going to get out of it. The bottom line is I'm going to make money by doing this. So therefore the lender is just a tool to help you achieve it.
Exactly. Thanks so much for your comments, Steve.
Thank you, Angelo.